Hello and welcome to Heritage University Presents. My name is Melissa Rogers and I am the Vice President of Business Development for Heritage Property Management Services. And if this is your first time joining us, thank you so much. We are thrilled to have you here. Tonight's class is going to be covering all things insurance because it is quite the hot topic this year. And we are joined by Jake Gillespie of Associations Insurance Agency, or affectionately known as AIAI, if you know. And we are going to be fielding some really great question and answer session for today. So Jake is going to talk a little bit about some association basics, but friends, this year's worth of courses is going to be a little bit more elevated. So we want to make sure that you have the basics tonight, but really we want this to be an interactive question and answer session. So as we go through the production tonight and the couple of slides to begin with, there is a Q&A that is in your upper right-hand corner, and we would love for you to submit your questions as you have them. And then we will, at the end of Jake's presentation, we will start the Q&A session. And Jake is also in the Q&A session going to be joined by our very own Director of Specialty Services, Danielle Williams, just in case any of you friends in the audience have any heritage-specific related questions, or possibly if you're a partner of ours. We know that some of you in the audience joining us are not Heritage partners, and that is okay, and we want you to benefit from this experience. We also recognize that a lot of the conversation that we're going to have tonight is going to be general in its totality, so if you have community-specific related questions, definitely look at your governing documents and seek out your association's attorney specifically. Okay. I think that covers all of our housekeeping rules. And just as a quick little introduction, for those of you that are joining us this evening, Jake and another one of his colleagues, Tyler, actually came to visit our managers. Jake's in Dallas right now. And so they came actually to visit our managers here at our home office in Atlanta. And we kind of did this really great interactive class. And really what tonight's session is going to be is a lot of those burning questions that our managers have, which really in line is what questions you as board members or even community members might have about your association. And why are the prices for insurance so expensive, Jake? Gosh. Anyway, so we're going to be covering those topics here momentarily, but again, we're going to do some brief discussion about the insurance, but really we want this to be interactive. We've got some questions that we're going to ask Jake, but we certainly want you to ask them as well. So without further ado, I introduce you to Jake Gillespie.
That was a fantastic introduction. Thank you, Melissa. So, yeah, like Melissa said, my name's Jake. I'm with AIAI, and just a little bit about myself. I've basically been in insurance since I graduated from college in 2019. Well, actually before then, I started in insurance in 2018. So about 6 years now. I've been in the commercial side of things, working with associations and businesses and stuff for the just hit my 2-year anniversary last month. So looking forward to many more years in the insurance industry, and I love it. My agency only does community associations. My agency and Heritage are owned by the same company, although we operate pretty independently from that company. So it's nice to, have everything kind of consolidated. Heritage and I work together a great amount. So yeah, six years in the insurance industry, went to Baylor University, studied economics, and then just ended up, becoming an agent, and wouldn't have it really any other way. So we can go to the next slide. These are just some information about my agency and what we do. And I guess I kind of touched on it. All we do is community associations. There are a couple of small exceptions, but I mean, mainly that's all we specialize in. So we have relationships with virtually all the carriers that will write community associations. We have service teams for claims, for account management, for your renewals, for billing, pretty much all that, in any type of issue that you would run into. And once we onboard a community, I'm pretty much the main point of contact as your agent. So we kind of streamline the communication. There you'll see a list of all the coverages. We'll get into some of those here in just a moment, but we can move on to the next slide. This is kind of just a breakdown of association coverage, and the main thing that I like to mention on this slide, I mean, a lot of people know about liability coverage and property coverage because those are on your house and they're also on your car most of the time. And then a lot of us carry umbrella coverage as well personally. The reason that they're kind of divided up that way is because the general liability coverages there off to the right fall in line. They follow form with each other. So umbrella, general liability, and directors and officers are all liability coverage, and they follow form with each other. And the umbrella extends over those two coverages. Then off to the left, you have property, crime, and workers' comp. Those apply to more either physical damages or monetary damages to the association's bank accounts. You can move along. Funny little picture there for you, and keep it going. All right, and I know this is a lot of information, so for any questions you have, we'll have that nice Q&A session at the end. I'll keep this pretty brief, kind of just breezing through here, but for your property insurance, this is the bulk of the policy cost for most associations, unless they don't have any type of amenities or common areas or common property. This is usually going to be the most cost-bearing portion, especially for condominiums and townhomes. So the values for your property insurance are determined a number of different ways. We recommend that you have an appraisal done once every 2 years or a reserve study. Those are getting to be very expensive nowadays. You know, a lot of associations can't really afford to do a reserve study. I mean, they can run up to $10,000 depending on the size of your association, but it's important to make sure you budget for those types of things, because it's all important, not just for insurance, but also for your reserves, making sure that you have enough money for the useful life of your common property, and making sure that it can be replaced when it needs to be. So, but reserve studies and appraisals are, you know, we recommend those once every 2 years. Majority of the time, the agent or the carrier will use a cost estimator. So I actually have access to something like this. I'm not a licensed appraiser, although ever since I've been an agent, I've had access to these cost estimating platforms, so I have experience with them. So I can get a good baseline of what it takes to replace a building, as long as I have the construction, the square footage, and all these different types of details. But to get the official rebuild cost as of, you know, today's date, it's always best to go through a licensed appraiser. Talking a little bit about co-insurance, I'm sure, there might be some, there might be some questions over co-insurance later on, but it's essentially a way that carriers ensure a community or a business or a building is insured to the proper value. So you want to have you want to have a lower co-insurance percentage, because it causes in the event of a claim, it would give you a smaller penalty if your building is underinsured. If your building is insured to the proper value, then co-insurance doesn't matter at all, because you'll still get the proper claim settlement. And then you've got down here your deductibles. I think in Georgia, the flat deductibles are still hanging around. They're hanging in there, especially for like all other perils. You'll pretty much always see anywhere between 1 to 10,000. Sometimes it goes to 25,000 for all other perils. That just means anything that's not related to weather, like wind or hail. And then your wind or hail deductibles typically, well, hopefully you'll be able to get a flat one, you know, like a 5,000 or 10,000. But lately, some associations have been getting transitioned to percentage deductibles, like the older, larger associations have been getting transitioned to those ones. So just to talk a little bit more about the property, it can range this is the wind and hail deductible again. They can take and put a percentage on there. It can go anywhere from 1 to 5%, and what that percentage is just of the overall value. So if the community is, like, let's say you have a $5 million community and there's a 1% deductible, then you've got a $50,000 deductible. So 1% doesn't sound very bad, but whenever it actually comes time for the claim to settle out, 1% is not the best. So most policies aren't going to include flood and earthquake coverage. Those are separate policies that you have to get added on. So flood, now that's not 100% of the 10 times out of 10. That's not going to be accurate. There are occasions where you can find a carrier to put those on there, but generally they're not going to be on a standard coverage form. So all of these other coverages that you see down here at the bottom are basically just like some extras that a community will see if they're with, and you'll hear me talk about this in a minute, surplus or an admitted carrier. If they're with an admitted carrier, which basically just means they're with a state-backed carrier, a lot of these enhancements you'll see on their policy, because usually the big names, the big companies, the admitted carriers automatically include these things. So business interruption, if there's a business in the building and it's displaced for some reason due to a fire or a loss, it covers the income that the business was bringing in. Like, you could think of like a mid-rise or an association that has a boutique or a restaurant or a bar or something like that. And I'll go over a couple of these, but accounts receivables, that's also follows form with your crime coverage in case there's any fraud or wire transfer theft. Demolition and increased cost of construction goes along with your ordinance or law. And that's if there's been any changes since the building was made with city ordinance or law, then the policy affords coverage to bring everything back up to code to today's date. Demolition and increased cost of construction pays for removal of a damaged building in order to bring it back. Like if a building was half damaged during a fire, it will pay to tear it down and then restore it. And I think that's equipment breakdown is also a good one to touch on, just because a lot of associations, older ones, like we have one with Heritage that I was working on last month. That's a mid-rise. They might have a standpipe. They might have, which is basically like a sprinkler system that runs up and down all the floors. They might have, central air or heating or a boiler, any of that type of thing. Any of that type of heavy equipment would be covered under equipment breakdown if there's like electrical surges or a short or something like that, and like the entire AC system goes down or something of that nature. We can move it along here. And so general liability coverage, it's standard to carry $1 million for all associations with a maximum of $2 million. You'll see that in most of your governing documents. Liquor liability is not something that is typically included, but it can be provided as long as your association is not in the business of selling or serving or distributing the liquor. Like if you're looking for liquor liability coverage because your association has a lot of parties with alcohol and you're worried about somebody getting injured, and that's a different type of situation than if your association is having parties where they sell and serve alcohol to all the so the difference is the BYOB versus actually serving or selling. Hired and non-owned auto, we get a lot of questions on this one. It is, most of the time, it's automatically included with the larger carriers. It can be removed sometimes at request, but it's essentially a coverage that will extend to association vehicles. and they're not owned by the association. This can be applied to any vehicle that's being used for association business. So if the have to run up to the bank to cash some checks for the treasurer has to run up to the bank, cash some checks for the association or something like that, or make payments, or everybody gets in the car and does a ride share over to an association event or a meeting, and there's an accident. Obviously, the personal policy of whoever's driving is going to be primary, but if there's a catastrophic loss, then this coverage would kick in if it's happening on behalf of the association. And then special events policy is just for any association sponsored event that happens throughout the year where things that are out of the ordinary are happening. So events like potlucks or things where concerts, events where there's large gatherings of people with, dancing, or if there's bouncy houses, or all sorts of things can kind of apply to a special events policy. The main thing to keep in mind is that if it's an association sponsored event where things are happening that are out of just, the ordinary daily activities of the association, it's probably a good idea to look at that type of coverage. Directors and officers coverage is very important because your board is constantly making decisions for the community, and as the community grows and grows and gets larger, the number of people that can get unhappy with the decisions gets larger and larger. So directors and officers is essentially, if you've ever heard of errors and omissions insurance, that's the exact same thing as it is for your board of directors. And if the board of directors is ever sued for a decision that they make in the community, or keeping somebody from making a decision in the community and they get sued for it, this helps yourself and board members from being personally responsible for that lawsuit. And you can see here, there's just a whole slew of things that it will protect against. And you feel free to ask me. I was going over all these crazy stories, D&O claims, back whenever I was visiting out in Atlanta. But yeah, it covers things that typically, might not be covered under, it covers a more broad, a broad slew of things than what would be covered under your general liability. So it's almost similar to your umbrella coverage if you think about it that way. Just because your general liability, typically you won't see things on there like discrimination or libel and slander or harassment, plagiarism. But boards get sued for those things a lot. Crime and fidelity coverage. A lot of boards think that the crime and fidelity coverage is for vandalism or for actual crime that happens throughout the community, but it's not. It's just for your bank accounts and reserves. So I recommend, state of Georgia requires that you carry at least 3 months worth of assessments along with your reserves, but it's different in each state. So like Texas doesn't require that. I still recommend it. If I have an association that's coming to me for a quote and they don't carry crime coverage, I'm always going to quote it, just because it's very advantageous coverage to have. And an association would never think that they need something like this until an issue happens where they have to file a claim for it. Until somebody runs off with the money that's in the bank accounts, it doesn't matter how small the association is. No association would ever think it's going to happen, especially not one with a property manager. But our property managers are covered under these crime and fidelity policies as well. So if we have if there's a rogue property manager, there's plenty of places to find coverage for something like that. Just to give a quick example of a story that I had on this, and I think I told Heritage about this, but there was a community in Colorado that had filed a hail claim, and it ended up paying out over $1 million for the hail claim to restore the roofs in the community. And one of the board members ended up resigning from the board and took the claim settlement and left. So that's an example of a situation where this coverage could kick in. umbrella coverage. And you'll see umbrella coverage anywhere from $1 million up to $25-50 million worth of coverage. I mean, they get crazy with it sometimes. I don't really. It depends on what amenities and exposures you have in your community, and then again, what your governing docs dictate that you need to carry. But I mean, I recommend any community carry at least some form of umbrella coverage. If you have a pool, then you definitely need it. If you have a clubhouse, you definitely need it. If you're getting close to 100 members, then you definitely need it. It's something that, again, is also not always thought about, but I mean, as soon as there's that catastrophic event where the general liability is exhausted or the directors and officers insurance is exhausted, then it's something that you need, because that's the umbrella goes to supplement your directors and officers, or it goes to supplement your general liability. Some umbrellas have the ability to provide the chosen limit of coverage over your D&O policy. Talked about that. Many carriers don't, but we definitely always try to do that. It's something that you want. It's a very good benefit to have. Market right now on umbrellas kind of changed a couple years ago. It was like right as when I was entering the industry, there were two programs that almost all communities were writing their umbrellas on, and they would basically bundle their umbrellas with their D&O and their crime insurance. At the end of 2020, I think it was the end of 2020 or maybe the start of 2021, they shut down that program. It was through one of our partners. It's called CNA. They were writing it, and then the other one was called Distinguished. But they were bundling those policies together. Everybody was getting great prices. You could get a $5 million umbrella for like $300-400. And then these things started changing, and now, I mean, it's starting to soften out a little bit for the umbrellas, but they're still a lot more expensive than they used to be. So $1 million of umbrella coverage is usually around $1,000 now. If you're getting into the $5 million, $10 million range, then you're definitely going to want to have the policies bundled. Otherwise, it's going to be very expensive. Workers' comp for an association, I should probably say this just to start. Workers' comp for an association is different than workers' comp for a contracting company because it doesn't function in the same way. So workers' comp, if you have a contract, we'll say like you have a contractor coming out to the community and they don't have insurance, this policy is not something that can go in place of a workers' comp policy that a subcontractor or contractor would bring to the community. These types of policies are more for association employees or volunteers or people working at direction of the board that get injured while they're doing it. So if you have board members going out and doing landscaping or cutting down trees and somebody's injured, then this is the type of policy that you would want to look for. I know it says here that it does cover for uninsured contractors. It doesn't function in the same way that their policy would. So your association policy is not the association is the insured. A contractor's policy, their workers' comp, he's the insured. So the workers' comp policy that an association would be carrying, if a contractor was injured, he'd be filing negligence against the association rather than going to his own policy. So that's how they function differently. And then, like, let's say another difference between the two, if an association were to file a workers' comp claim with a contractor, and this contractor, let's say something crazy like he cut his leg off and he was in the hospital, and then these medical bills max out the limit, this association's more than likely not going to be able to get workers' comp, their own workers' comp policy at an affordable rate for quite a while. They're going to be stuck. I mean, if they do get one, it's going to be very expensive. So going back to the contractor's version of his coverage, if he were to go file a claim on his own workers' comp, that's a different situation. he's filing it under his business. It's going to follow him around. It functions in a different way. So it's a matter of who's getting protected by the workers' comp. It says volunteers are not typically covered by a workers' comp policy, but we can get those. So if you have a lot of, communities if you have a lot of people doing work around the community on a volunteer basis, this is something you should look into. Like I had some retirement communities that they would be throwing these ballroom, dances or whatever at their clubhouse, and they'd have all the volunteers lifting the tables and hauling everything out and doing all the chairs and getting all the decorations and whatever. So and that's not always the safest, especially when it's a retirement community. So this is something that I had them look into. We're going to go over the claims process just a little bit. And really, this is a ton of information. I'm trying to keep this short and succinct. If you have any questions on this, feel free to ask me. But the main thing I want to kind of stress on here is just to communicate all of the information. Everything that happens in the community in regards to a loss needs to be communicated to an agent or a claims manager. It doesn't go to a carrier. I mean, it can go to the property manager. The property manager needs to relay it straight to the agency. It's all about communication. Because when a claim happens, you're paying for the coverage. You want to make sure that the coverage pays out to your benefit. In order for that to happen, then we need to make sure we're getting all the information to the carrier timely. We need to make sure that they have everything that they need, that they can investigate fully, determine coverage, determine liability, get through their entire process. So communication is extremely important. But there's a great, if you want to do a screenshot or float this over to the boards, I mean, that's a great bullet list right there of the claims process. It gives you a great rundown of how it works. This is just a checklist of kind of everything we went over, but I'm more ready to get into y'all's questions, so we can move it along.
Yay, thank you. So a couple of points to add to you on that one. For some of the things that you pointed out, yes, we definitely, if you partner with a manager and there's a claim response or something like that, that is something that we are going to work with. But a lot of the boards potentially that are watching this too, Tyler, Jake, do not potentially have a management company. And so this is a great instructional for everybody so that they understand, hey, listen, when do I have to file this? And this is largely, friends, exactly the content that even our managers ask for too, so this is great. We did have a couple of questions start to percolate, which I am so excited. So the very first one that we have jumps back to the very, very beginning of what you were talking about when you were kind of just reviewing the general liability. And we kind of talked about different umbrella coverages. We had a question that says, can't you just purchase the general liability in the same range that you would have for the umbrella coverage instead of having the two separate policies? I agree. I was like, that's a very good question. Oh, we muted you on accident. Yeah. There you go. Okay.
It is a good question. Yeah. You can do that. It's called excess liability coverage. Generally, your general liability policy is not. They don't sell those over like 4 million per year to 6 million max. But the general like I was saying earlier, a general liability policy doesn't cover as much as an umbrella policy does. So if there are if there is a claim or something filed against the association for negligence, libel, slander, and it goes to the general liability policy and it's declined because it's not covered, then there might, you could, if you have an umbrella policy, it could cover that. But and that's why I recommend you carry it. But you can also, yes, you can do, like, if you wanted to do $1 million liability policy, you could carry a $2 or $3 million excess to get like a larger chunk. But it's more about what's covered when it comes to the difference between the two.
And ideally, you like Jake said earlier, you want it to sit over that D&O, you want it to sit over that Crown Fidelity, ideally, so that if you do have those large claims on fraud on the bank account or, a D&O claim against the board that's larger for whatever reason, it can jump over that if need be, if the the main policy is taken up, the limits hit.
A great opener. I love that. Okay.
Good
So
question.
we have two questions in one here. So I'm going to go ahead and love this because you kind of broached on this and we knew we were going to get a lot of questions about this particular topic. So if we have unpaid homeowner volunteers, which I think you might have addressed, what insurance is recommended versus required? And so that's like a two-parter because it depends is really the answer because of your documents. However, we're talking about homeowner volunteers, which you had just addressed in a couple of the last slides for potentially having their own coverage, if need be.
Yeah, absolutely. Yeah. So question was, what kind of coverage would you need for if you have community members doing volunteer work? And so, yeah, I mean, it is that workers' comp volunteer policy. I mean, it's not something that, again, I mean, I always try to stress how it doesn't work. That's the type of situation you would want to use it in, is if you have volunteers working around the community. So yes, I think I'll just leave it at that.
Great. Okay. And here's the second part of the question. If our insurance has medical coverage of $5,000, this seems really low. What would happen if someone is injured and history's bill is $25,000? So this is also a very good question.
So I think that was probably hospital's bill. I think that was a.
Oh, sorry.
Yeah, I think it was a typo, but I'm guessing that's probably.
Oh yeah, that would be hospital bill.
No, I understood it. It's all good.
Yeah. No, that's kind of how today is. Jake, I'm guessing they mean. I'm thinking the medical from the property coverage or liability coverage.
Yeah, well, they do that. So they do the, you'll have $1 million liability coverage, and then there is medical expense coverage for $5,000, or that, you can pick. It's essentially, it's the same thing as your auto, your auto coverage. You have PIP or medical expenses on there for your personal policy. So it doesn't cover the medical expenses if somebody was to break their leg in a car accident. It's just going to cover the expenses to get them to the hospital, or just the basic stuff. So like an ambulance or a life flight, it would go to apply to that. But it is something. And then like if they end up suing the association because they have, broken leg or broken back or something, the further medical bills would be applied to the liability policy. So that first $5,000 is just, that's the quick payment. That's the first thing that goes when an injury claim is filed with a carrier. Those medical expense payments, that's the first thing that goes out.
Which would also be why it would be very helpful to have that volunteer worker comp policy behind that, just in conjunction with that.
Okay, so now I'm going to throw the softball question. I think that everybody came to tonight's class to hear the answer for, and thank you to the person that asked it. I'm going to say, why the heck? I threw that heck part in there. Why have condo insurance rates / costs for master property and liability insurance rates jumped up so much this year, even if we don't have any claims or few claims on the policy? Great question.
That's a great question.
Yeah. And I mean, I talk about this every day. It's and I mean, I could sit here and talk to you probably for the next 6 hours about it, but they just, the biggest, I think the biggest reason is the carrier's appetite, and the number of carriers that are left right now writing condo insurance. So when I start, a lot has changed since I started. I've been doing insurance for 6 years, commercial insurance only for a little over 2. But even since I've been in the commercial sector, it's changed so much. As soon as I got into the industry in 2020, we had 2 two really big carriers, two big property carriers. One is called AMCAP, the other was called Strata. And both of those went out of business, catastrophic. So, I mean, you might not be having claims, but claims are happening all across the country, and these insurance companies all share in the losses. So, I mean, as these claims are happening, there's like the wildfires. The big one is that condo collapse. It kind of started everything, that Surfside condo collapse down in Florida. And then there's the wildfires. We have them now happening in Texas.
And hurricanes.
Hurricanes, yeah, got hurricanes, hailstorms. So you got to keep in mind they all share in these losses. And they kind of, when an insurance company goes out of business like that, it leaves a lot of people scrambling, and they don't know kind of where they're going to go to get coverage. So all of these people, they have to find somewhere else to get coverage. The market gets narrower, and then the underwriters get pickier. Another thing that we can talk about are the replacement costs going up. The average replacement cost 5 or 10 years ago. I mean, the guy that I took over for, this agency started out in 2003. The guy that I took over for had been here for like 12 years. Some of the accounts that I'm looking at that he was working on, I mean, he had them insured at like $100 a square foot back whenever he was writing them. And I mean, that would not get you, it would get you barely anything nowadays. I mean, like the construction costs have skyrocketed in the last couple of years, almost, I mean, probably doubled or more. So the construction costs are going up, and that causes the replacement costs on the policies to be higher. That raises the premium. Claims cost is higher.
Labor cost.
Labor cost. The labor cost is going up. So I mean, there's a whole combination of factors, and when you have so few carriers left to write the policies, and you have so many people shopping at once, it absolutely swamps the market. So everybody's taking increases, everybody's shopping, and underwriters might have looked at $500,000 worth of premium in a month. 5 years ago, they might have looked at $500,000 worth of premium in a month and written 200,000. Now they can still only write 200,000, but they have to look at over $1 million or $2 million worth of opportunities a month. So they get very, very picky about what they want to write and what they're going to accept. And I mean, it's become a difficult marketplace, but the prices, they're gonna, I think, there'll still be some increases this year. And I'm talking to a lot of surplus brokers, about what their indications are for next year, and they think that, like the 50, 60, 100% increases, if you haven't had a claim, are probably not going to continue into 2024. Fingers crossed. So we're looking at, I mean, the increases will still be there, but we're looking at some stabilization. Like, we're not looking at like doubling, or, I mean, I've got one right now that it's a high rise down in Austin where we're trying to place it. They were with a admitted carrier, which is a state-backed carrier. They got non-renewed because it's too old of a building, and now, I mean, they go from paying $70,000 up to $300,000. I mean, it's crazy, and it is. I mean, it's a $60 million building. It's a very expensive building, but I mean, you used to be able to insure a $60 million building for $70,000, and I mean, it just doesn't happen anymore unless it's brand new.
And Jake, didn't you mention too that the older the building, the more challenge that they're receiving too? So didn't you say if the building was built prior to a specific year, we're seeing? I mean,
we have carriers now that are basically saying if your community was made prior to 2000, we just will not look at it. Period. Right. And then if you're a condo and if you're a townhome community that was built in the 70s and 80s, and the construction of your community is frame, then Those are the ones that are taking the brunt of the increase right now.
Listen,
Which is the vast majority of
Yeah.
communities, condo communities out there.
Yeah.
We're built in. There was I'm learning this because I'm a younger guy myself, but I mean, there was a huge influx of construction in the 70s and 80s, and it was all townhome communities like this. I mean, Texas is just chock full of them. So.
Yeah. And most of our 80s, early 90s condos in the Atlanta area are mid-rise frames, guys. So it's a hard market for that. We have, to Jake's point, there are tons of carriers that have pulled out of the Georgia market, but also just pulled out of habitational, period. They're not interested in the risk.
Or gone out of business.
Yeah,
Right.
just gone, yeah. Whether they're interested or not, they're just not around. So
Yeah.
it is a really difficult market right now.
But that's why you
Thanks
want to work with somebody that has access to everybody else that's left out there and has good relationships with them. The relationships are important, because like I said, that puts you at the top of the list. When the underwriter has $2 million in premium to look at, they're going to say, okay, I'm going to look at whatever from AIAI because I work with them more. So.
And you want to start early. Start early. Don't wait a month before your renewal or 3 weeks. You're not going to get a quote in time. You're not. It's not a lack of trying on your part or a lack of trying on the agent's part. It's just everyone's looking for quotes. There's a very thin market of carriers right now, and there's only so many underwriters in those carriers' office to look at all these requests. Start early.
I know, and I thought you're exactly right. Like I'm thinking here when I come into the insurance industry, we've got just teams and teams of people that are running all of this stuff. No, it's very small teams. Yeah. My team personally, I mean, there's 2 agents. We have 2 agents running our whole book of business in my office. And so, I mean, and then our underwriters, like we've got even with our really big carriers, we have, enough room to sit them all down at a conference table when they come into the office. So, I mean, it's not just massive teams of people. We're definitely, we're all feeling the strain right now.
Just to give you kind of an idea, Heritage starts shopping communities 120 to 90 days out. We start building the data, getting it over to Jake and his counterpart Tyler, and making sure they have what they need, asking the questions. They come back to us and ask more questions that the underwriter needs. It's a process, and you really have to start that early.
I should have talked about that probably a little bit more at the beginning, but yeah, it is. You need to start your quoting early if you're looking to get competitive bids. It has to start about 100 days out. You've got to get the most important thing that you have to do is get the loss reports from your current agent so that you can bid out the policy. If you're happy with your agent and they have access to all of the markets, they're going to shop your policy to everybody, great. Don't worry about it. But if you're not getting the alternatives that you want from your agent, then ask them for the loss reports, get it marketed to somebody, 100 days ahead of the renewal. And the reason why it needs to happen so far ahead is because your agent doesn't want to lose your business. So he's going to hang on to those loss reports. Mm-hmm. And it's not like personal insurance where I can go into my computer and run a claims report and pull your driving history and pull all that stuff. Used to be able to do it, can't do it anymore. So you gotta get all the information from your current agent in order for me to quote, and that's the hardest thing to do. So about 100 days out, you contact your agent, you get the loss reports or put in a request for the loss reports. There's probably, as we approach the renewal 60 to 90 days, there's going to be a few items here and there that I'll have to get to review, governing docs, your current policy, whatever that may be, information about your community. And then I'd say, most of the time agents, if you bother them, they'll release the loss run somewhere around 60 to 90 days. So I'll get those. I'll put in a submission for your community to all of my available carriers or whatever markets that are open. And then about 30 to 60 days out, that's the time that I'm working with my carriers, giving they'll send me back a bunch of questions. They'll be like, okay, what's this? What needs to be covered? Do they need this coverage? Blah, blah, blah. And so I'm basically helping them determine what coverage forms need to be included. they're asking me about the exposures in your community. And then generally around 15 to 30 days, that's generally when they'll release a quote. So I've got a lot of communities, who are looking for their quotes like 2 months ahead. It's just not, it just does not happen. It's usually around 15 to 30 days. And a lot of times with this market, it's even shorter than that. But that's typically how the process works. And then the key is just to stay ahead of it as best as you can.
Okay, so the next, and thank you very much. That was a lot, and I'm sure we could probably continue talking about all of those things because I had so many other things that just popped in my head too. I was like, ooh, it's challenging for everyone involved. Mm-hmm. So I'll also piggyback. If you are a Heritage partner, please pay attention to our insurance team when they reach out to you and let you know that you have options. Jake, do you want to quickly run through, because we're about to get into some technical questions. Do you want to quickly, since you were kind of talking about just what's happening in the market, do you want to talk about the difference that the difference of actually bidding out insurance versus bidding out a landscape vendor? It's a little bit of a different, you had already mentioned having a good relationship, but what if you do want to change that relationship? What would that look like? And what happens for the association?
Sure. Yeah. So, I mean, if at all possible, you want to work with one agent. That's what in an ideal world, you work with one agent who has access to all carriers who can shop for you. But that's just not how it always happens. Agents, like their books get really big. They have too many communities. Their smaller communities might not get enough attention. So communities that want to get multiple bids might not always get those, they might not always get 3 bids at their renewal. And it can happen for a number of different reasons. But that's why you would utilize my services. Like, let's say, and let's say there's a number of different ways that we can bring a community to my agency. I mean, we can beat the rate that your current agent has on the policy. We can give you the same coverage that you have, just with a better price, and just win your account. Or, let's say your agent is not responding to any of your requests. You try to file a claim, he's not picking up the phone. You're trying to pay for your policy, you can't get in touch, you don't know who to contact, or he's not releasing the loss runs like he's supposed to. There are other ways you can transfer your coverage to another agency. There's something called a broker of record, which basically allows my agency to move your current coverage under our umbrella, as long as I have access to all of the companies that are writing your community at that point in time. So if you're insured with a company that I have and you're unhappy with your agent, then you just sign a form and you can move all of your coverage over to my agency. We have the backing of a billion-dollar company. Most of the time we have much better financing rates. I know that Danielle and Melissa can attest to our service team. I pick up my phone as much as I can, as long as I'm not getting 2 calls at once. But yeah, the broker of record is great. I love to beat the price on a community's renewal. Just, I love to make, I'm not saying this in a I love to make another agent look bad. I love to get, a better price, better coverage, and just come in and save the day. But that can't always happen at every renewal. So if you're unhappy,
to that point, I was going to say, I know you love to get better pricing, but I love when you get us better coverage for our clients. Right. So it may be slightly higher, but when I can point out to our clients that there's better coverage there, I love that, when it's going to protect our client. So it's a win. I have to tell you, it's a win for me for our team to present that. And so all the ways that we can, we're talking about broker of records for any Heritage client. Just so you guys know, you don't have to do this legwork. There's a insurance team, if you haven't you've probably at least talked to him, dealt with him, heard from him, seen an email from him, something. We're already doing this for you. It is very, Jake touched on, it's ideal to deal with one agent. We're doing that for you. We're getting you options. We're reaching out to AIAI, getting you some quotes if they can beat it. And the great thing about Jake is he's honest. He says, I can beat it, or I can get you something comparable. I can get you something better. The price may not be better, but the terms are better, which is better coverage, guys. Or he will flat out tell me, I can't compete with it. I can't get you better coverage at a better price, or even same coverage at a decent price. He tells me that. Which I appreciate the honesty, so I can tell the clients. But your current agent is also looking at it potentially. There's certain situations that he mentioned that the agents aren't responding to us. I've structured ways for our team to get around that if we're not getting responses, just so you guys understand that we will ask the board to sign a form so we can go straight to the carrier and get those loss runs if we can't get the agents to respond to us. So we have, we've done it so long, we've seen all the scenarios that we have structured certain ways. If you're not a Heritage client, I'm happy to answer questions to help you navigate that. But I'm also happy to help you reach out to Jake, and he's happy to help you shop that insurance, because I will tell you, you won't be disappointed. He's going to be honest with you. But there's a million ways to shop insurance, and there's a million ways to get your current policies with an agent who will serve you best.
These are, and it never ceases to amaze me. As long as we've been doing community association management and I've been a manager, I genuinely find myself at least once a year explaining the process of how to bid out insurance, or what that process looks like towards the director. So this is incredibly important, and I appreciate you emphasizing so much time spent on that, because we do want to both set you up for success and ourselves up for success with the transparency of that. So here's some fun questions, and I love this. I want to veer, because we've been talking specifically about condominiums. You know, obviously a lot of this specifically relates to condominiums because they have more physical asset, or they have more common area from time to time than maybe a common law HOA. So one of the questions that our community managers asked that I wanted to make sure that we dropped in here, in addition to what our audience is asking, is what if I am an association that, you know, I have detention pond maintenance and I have front entrance? Why do I need to carry coverage? Do I have to carry property coverage? If so, what does that look like? Are you sure? And the answer is yes. And more than likely because your governing documents require it. But could you kind of speak to that kind of misconception that even if you don't have any what we call sexy amenities, which are the pool, the tennis courts, those are not sexy when we're talking about liability coverage, by the way, friends, especially if you have a diving board or a slide. So from that standpoint, talk about what coverage looks like for associations that have zero amenities.
So if the association's responsible for them, maintains them, is responsible if somebody falls on them, you need to insure them. So if it's if a fence is damaged, you have a front insurance, and Jake, definitely jump in here, a front insurance, a pool, a clubhouse. If it's your property as the association, you need to have a value and insure it, because ultimately, and I say if you're responsible for maintenance, that gets a little hairy, and we have a few townhomes that gets a really hairy on, because there's a difference between maintenance and insurability. So I'm not going to get in deep on that. If you need some help with that, we can talk offline. I'm happy to always talk to a board about that, but there is a lot of confusion on who's responsible for what in that. But if the association, per your governing docs, is responsible for insuring it, you need to insure it, because that goes back to that whole, you can be sued for not following your covenants and your bylaws.
You can
So
be
there's
sued for
that.
anything.
I love
Well,
it.
you could totally be sued for anything. You're 100% right on
if
that.
you have any type of common area whatsoever, I mean, you have to have, I mean, and most associations are going to have a board. I mean, even if it's a board of 2 people, you have to have at least general liability. Yeah, or 1 person. You have to have at least general liability. You have to have at least directors and officers, unless you want to be sued and held personally responsible for something that happens. I mean, somebody's riding their bike, down the street and hits a pothole and decides to sue the association.
And then I will throw into all of our Heritage fam, your management contract states certain coverages you must maintain to be in compliance with your contract. So just to protect yourself as a board member, your association, make sure you have the insurance, the covenant state, and that you're protecting. I mean, guys, as a board member, please at least make sure you're protecting yourself with that D&O coverage. Like it's not, overall D&O is really not an expensive coverage. So please don't forego that. Crime and Fidelity, it's not overly expensive. And I will say, I get a lot of questions about why is that necessary if we have a management company. You're right. We do pay the bills, guys. We absolutely do. And we do have coverage. But as Jake said, we are also, it's kind of like, oh, there's another coverage. There's another layer there. You guys as the boards direct us on what to do with that money. So if you make bad direction or bad decisions, that coverage is there to protect you and to protect the money for the association. So you are the ones making those decisions. We don't make transfers from the reserves unless we're advised. So just kind of keep those things in mind.
All very good points. And I'm glad that you brought that up specifically about the management contract too, because that was something that Jake had talked about when he was going through the slides originally, where we were mentioning some of those things. It's not just in your governing documents. If you are a partner with Heritage, we do that. We have that protection for you. So okay, we have like 3 minutes and about 7 questions. So we're going to do a lightning round because we've kind of addressed some of these, but one of them I really want to make sure that we give ample time to discuss because I know it's a real question that is on a lot of board members' minds. And to everybody, please don't chimp out on your insurance. We know it's probably among the highest line items that you have on your budget right now. That's going to be temporary. I hope, fingers crossed and everything kind of gets itself back up. So you're not alone in what you're experiencing. Just know this. Okay. So replacement cost. Is replacement coverage based on the construction materials and systems at the time of the claim? And should we document with photos and current construction? Great questions.
Yes. Yeah. It's at the time of the loss for sure.
Yep.
It's current market value for your claim.
Okay. And yes, always take pictures whenever possible. Always take pictures, have some type of proof. If you're a type of person or if something happens and you want to jot down notes so that you make sure that you have certain specifics in mind, as unfortunate as that sounds, I think that's a great thing to also do as well. Okay, our association is made up of a triplex building. The overall coverage states an amount, then the building coverage amount are stated elsewhere in the declaration or in the policy. Is the building coverage the governing amount or the individual policy is what I'm thinking that they're asking right here. Can you see the question, Jake? And then it says, and if one unit of the 3 is damaged, the building amount covers the limits. Okay, so we're talking about, it's all association insurance that they're referencing here, but they're talking about, it sounds like there's 3 different buildings. And so from those 3 different buildings, there's a master coverage, and then there's an individual building. And this almost kind of sounds like a homeowner's policy first, and then the deductible would then kick in for the master potentially. I'm not sure. Great questions.
I almost want to see the policy before I make it.
So very technical
because sure. You almost want to see what the policy states before, I don't.
Okay.
Yeah, I'd have to see the policy.
Hey, friends who asked that question, reach out to us afterwards and we'll go ahead and get some answers for you on that one. I want to make sure we got that, and I appreciate that. It was a good series of questions.
Yeah, I just don't want to assume I understand that one.
Okay. So if, let's say I'm going to go up one more, see if we've got, okay, if a handyman, okay, so these are the next two that are really kind of the questions that I want us to kind of wrap up with. And this is where we were talking about the vendor insurance and working with unlicensed vendors. So first off, this is a licensed vendor potentially. We're just going to say hypothetically in this question. If a handyman has insurance, right, but gets injured on the property, would the association still be held responsible? Great question.
So that just depends if they're negligent. Like if the handyman goes and talks to a lawyer and the lawyer tries to sue the association for negligence, they might be held responsible. It just depends on the situation.
Okay.
Just remember, they can sue them. It just depends on if the judge finds them favorable or not. Anybody can be sued for anything, like we said.
Yes. Yeah.
They can absolutely sue them.
They
Yeah.
can sue them.
It just depends on how the judge finds it.
Right.
Okay. So back to staying in this vein and back to an original question that was asked a moment ago. If we have unpaid homeowner volunteers that, have what is the insurance requirement, which we talked about, the volunteer workman's comp. Could we talk more about the board that doesn't follow the rules in the declaration? So what essentially happens, and I don't know if technically we would be the right person to answer this question if it wouldn't more be legal on this one, but it's essentially the way that I'm understanding this person is asking what happens to the board if they don't have the policies that their governing documents really require. And I think that's a better question.
Yeah, no, and I mean, it is like you're saying, it's something that kind of would have to go back to the board for review or to their attorney, but it sets yourself up for a D&O claim. It sets yourself in the future. I mean, if something happens and then the association has to pay out for an injured volunteer, and then somebody else on the board is like, why weren't we carrying that coverage? And then, another lawsuit. Oh, then it goes to the D&O coverage because the board was negligent in carrying the right coverage. So
awesome. Well, perfect. And I'm going to ask this last one that I see you talking about. So just to verify, loss runs, when you had kind of pointed that out, how many years is it? Is it 3 years or 5 years? And when do
it's
those
5 for the good ones?
come off?
Like I see
5.
Danielle saying 5. It's 5 for the good ones. I mean, you want the more is always better for sure. Yeah. More is always better.
Most of the carriers and Jake,
more years,
saying
not
5.
claims, friends. More years.
Yeah. We don't want 5 years of claims. No, we don't want that. Please don't do that. No, they're going to want to see 5 years of history, friends, not 5 years of claims. we don't want to see that. So 5 years of history on your claims history.
And forgive us for trying to have a little bit of fun poking at such a very heavy topic.
You have to make it fun.
Yeah, this is, Danielle and I, when we were talking about how we were going to bring this class to you, because we've been getting a lot of questions from board members, obviously, and from our managers specifically, which told us, hey, there's a need that we might want to address here. When we were talking about this, we were like, oh my gosh, this could be a 3-hour course in and of itself, just because there's so many questions and there's so many facets of insurance that we want people to understand. So if we did not get a chance to answer your questions, we want you to reach out to us. Everybody is going to get a copy of the slides tonight. I did want to address that. We put that in the chat as well. So don't worry about having to screenshot that checklist. We're going to make sure that you get it. I thought everything that you provided in the slides, Jake, was excellent. We sincerely appreciate you being a part of this conversation with us. Insurance is never a fun topic to talk about. And so we really try to do our very best to spice things up a smidge, the best that we can, especially when we're dealing with topics that are not, the best for associations at the moment. So This class, along with all of our other courses that we've done in the last several years, are available on our YouTube page. And you can visit heritageproperty.com to take a look at all of our previous classes. This actually does wrap up the 2023 classes for Heritage University. So stay tuned while we release our 2024 calendar in the upcoming month. We sincerely appreciate everybody who participated tonight and asked your questions. Again, reach out to us if we can be of any additional assistance after this episode. And we look forward to seeing you again in the audience really soon. Thank you, everybody. Have a great night.